All Things Money with David Blain, a discussion about your money, including everything from investing and taxes to real estate. Now with this week's program from D.L. Blain and Company in New Bern, here's David Blain.
Hello and welcome to All Things Money. My name is David Blain, and we're glad you could join us for today's show. We've got an exciting show today. We're going to talk a little bit about markets. We're going to wrap up some of our tax information that we've been covering the past several weeks. So without further ado, let's get into it. Before we do, if you have any comments or questions on the show, I'd like to give out the number, which is 252-633-0107. Our email for the show is allthingsmoney@dlblain.com. And of course, you can visit us on the web at www.dlblain.com. That's DLBLAIN.com. So we're going to wrap up our multi-show segments on the tax law changes and give you a few last-minute tax deductions that maybe you hadn't thought of when you're getting your taxes done, doing them yourself. Maybe you have a CPA. Maybe we do them for you. We have a lot of expertise in tax preparation. It's a very important part of wealth management, and we are very involved with that. So before we do, I thought I would cover, this is a great piece from Chuck Jaffe on Market Watch, CBS Market Watch. And the title of this article is, "If You Can't Join 'Em, Beat 'Em." And it's a great little article that I thought we should highlight some very important lessons from it. The first is, I asked this question the other day to somebody. I said, what do you think the average holding period for a stock on the New York Stock Exchange is? You know, how many days or years or months? Well, the people that were sitting there, they guessed, a couple of days, couple of months or whatever. Well, it's now 22 seconds. And that is from a professor who studies this sort of thing, figured out that high-frequency trading has contributed to a holding period of 22 seconds for the average stock. You've got the hedge funds. High-frequency trading accounts for as much as 70% of the action on Wall Street. And these are funds and the Goldman Sachs and these big institutions that are just constantly trading their stocks. Now, on the positive side, it does provide some liquidity to the market. There's normally a market for the stock that you may be wanting to buy or sell. But from an individual perspective, or even from an institutional perspective, a smaller institution like myself, or frankly, basically anyone out there in this audience that they deal with other than the extremely large institutions, you can't compete with that. You are not going to have the systems and the market data to be able to compete with these types of high-frequency traders. And so our advantage as investors, and I consider myself a smaller investor, even though we manage millions and millions of dollars, I consider myself a small investor in the grand scheme of Wall Street. And our advantage is stretching our time horizon out. Don't look at a stock for 22 seconds. Stretch your time horizon out. Adopt a long-term investment strategy that maybe, on a day or a week or a month or even yearly basis, you may not perform in line with what the market's doing or some high-frequency trading mutual fund. But over the long period of time, you will definitely come out ahead as opposed to trying to keep up with these traders that are constantly in and out of the market. Your advantage as a smaller investor is stretching that time horizon out, pulling yourself out of the day-to-day moves of the market. It does not necessarily mean that I'm not a buy and forget type investor. There are long stretches of time where stocks do not make money. We just went through a decade where the return on the S&P 500 was essentially flat. Japan has had 20, 30 years of flat returns. But by the same token, thinking that you're going to be able to trade stocks every 22 seconds and keep up with the institutions is, you're not going to do very well. So we think that taking somewhat of an intermediate time horizon in between the short-term institutions that are focused on monthly, frankly, daily, weekly, monthly, and quarterly numbers, and stretching your time frame out to focusing on 2, 3, 4-year type returns, what is positioned to make some money over those time periods, and you'll do very well. So let's get back to finishing up our segment on taxes. The past couple of shows we've been reviewing the numerous changes that were made in 2010 to the tax laws. Of course, the biggest change being that the tax rates themselves were kept at the Bush-era levels. They did not go up. The estate tax was resurrected, although at much lower tax levels and a much higher exemption level. And of course, there was the new Medicare tax imposed on unearned income, as well as numerous provisions in the health care law. If you missed those shows, go back, look us up on the web, and we'll have archived copies of those shows on the web you can listen to. What I want to finish up today on the tax is just kind of to summarize, as you're getting your tax information together, some deductions that we don't want you to forget about. And we're going to start with some business tax deductions. A lot of our clients, a lot of people out there own small businesses, medium businesses, and there are a number of tax deductions available to business owners that are not available to individuals. So first and foremost, believe it or not, this is something very basic, but I've seen people forget it, especially for the smallest of businesses, maybe that you're starting out, that of course, whatever you purchase for resale is a deduction. So if you're selling widgets and you purchase that widget, you mark it up and you sell it, the cost of that widget is a deduction. Of course, your employees pay benefits for employees like health care, adoption assistance, educational assistance, life insurance, these type of things. Retirement plans, pensions and profit sharing. If you contribute to employees' SEP, simple 401k, those type of retirement plans, those are all business deductions. Auto maintenance and mileage. This is a very confusing area of the tax code, but it's very lucrative for deductions. You can take either what's called the standard mileage rate, which you get a deduction of a per cents mile for every mile you drive your vehicle, or you can take actual expenses, meaning you add up your gas, oil, repairs, and things throughout the year, and on top of that you get a depreciation deduction for your car, and this is all deducted from your business income. Well, we're coming to the end of our first segment here. When we come back, we'll continue with some business tax deductions as well as some good deductions for those of you individuals out there. For All Things Money, I'm David Blain.